You swipe your card for groceries, and suddenly you're doing the math on an exploding balance. Borrowing money has become a lot more expensive. This upward pressure mirrors a massive sovereign debt pile. The US government currently owes $37 trillion. Every single day, billions flow out of the Treasury to keep massive operations running, from maintaining global military bases to funding the defense sector. And that daily outflow also has to cover massive civilian obligations, like sending out millions of Social Security checks. When you add up the daily cost of defense, infrastructure, and social programs, the spending consistently exceeds the tax revenue coming in. To cover the difference, the government borrows. For over a decade, borrowing was incredibly cheap. Interest rates were hovering near zero, so taking on massive amounts of debt didn't immediately strain the budget. That era of cheap money is completely over. Interest rates have climbed sharply. Look at this chart tracking the cost of interest on the national debt. We see a relatively flat line for years, and then a sudden, sharp hockey stick curve upward as those higher rates kick in. Covering the interest alone is now costing the government hundreds of billions of dollars, putting it on track to eclipse major programs as one of the largest single expenses in the federal budget. The immediate risk lies in the suffocating daily cost of maintaining that $37 trillion principle, forcing the government to change how it operates. Managing the math behind this falls to one institution, the Federal Reserve. Their primary blunt tool for steering the entire U.S. economy is raising or lowering interest rates. But the Fed is caught in a difficult balancing act. They have to fight off rising consumer prices while trying to protect economic growth at the exact same time. If they keep interest rates high to crush inflation, the government is forced to pay a premium on its debt, and broader economic growth grinds to a halt. But if they panic and drop interest rates too quickly to stimulate growth, they risk letting runaway inflation surge right back into the economy. There is no clean exit. Pulling the lever to fix prices mathematically guarantees squeezing the budget or sacrificing jobs somewhere else. The decisions made inside the Fed don't stay contained in Washington. They act as a transmission mechanism that directly hits your wallet. The moment rates change, the blast radius dictates the health of the stock market and decides whether you can afford the monthly payment on a new home. The ripple effect dictates business investment, which trickles down into job security and how much cash you have left over for consumer spending. This interconnected pipeline is exactly why global investors parse every single syllable spoken at a Federal Reserve meeting. To find the money to pay its debts, the government must issue more treasury bonds, which pushes up the baseline interest rates for the entire economy. This directly forces banks to charge you more for a mortgage or a car loan. As the government spends more of its budget just servicing its own debt, the mathematical pressure to raise future taxes on regular Americans continues to build. More concerning is what happens during a crisis. With so much cash tied up in interest payments, the government simply has less flexibility to deploy emergency funds if the economy hits a wall. Now, the economy hasn't buckled because the US dollar is still the world's primary reserve currency. Global markets still trust American debt. That trust acts as a powerful shield, but market psychology is incredibly fragile. Everything looks perfectly stable, right up until the moment confidence breaks. None of this means a massive recession is guaranteed tomorrow, but it does mean the margin for error at the federal level is shrinking fast, which shifts the burden of managing financial risk squarely onto your shoulders. Understanding where interest rates and inflation are heading helps you make highly informed choices about your personal saving and retirement planning. America's $37 trillion debt represents a permanent structural shift in the economy, one that requires every individual to actively adapt their financial survival strategy.